What's up, everyone? Hope you guys have been doing good. So for tonight's class, it's going to be very biased. I mentioned that to you guys a few days ago when I brought up the actual event that we're doing for the class, obviously. The biggest thing about trading screens or like setup people use, whether it's Thinkorswim or they use Interactive Broker, Weeble, Robinhood, whatever broker people tend to use, every person uses a different style, whether it's charts, indicators, volume, they read tape, they use the contract. Everyone has a different style that fits them. So I'm going to be speaking on what I personally use only because I hate speaking on things that I don't have experience in. I hate speaking on things that I have not done personally that I can teach people. I don't like to watch other people do something specific and then I use what they taught me to teach someone else. I like to have like firsthand experience on anything that I reiterate to other people. So while we're going over just trading screens, like how I use, if you guys have any questions about a specific broker that you use and how to make that work, we can see if there's other people in the current class right now that may use the same type of broker or just the same setup for the screens that you guys can like talk and work through to see if there's something that you could use, someone else may use. So just going right into it. So when using the idea of what should I use for my screen, what should I be watching the heaviest, the biggest thing that I use, and this is, I would assume everyone uses this at some point throughout the day, is just a watch list. I know it's very basic, but there's more to it than just showing your watch list and then you see a list of stocks, alphabetical order. Maybe it's price per share, highest to lowest. Maybe it's percent gains on the day to percent lowest on the day. Many people just have a watch list, but they don't utilize it to make it fit who they are. And what I mean by that, many people watch, and I'm not throwing anyone under the bus, I'm just speaking on like the broad perspective of things so other people can relate to this. Many people trade Tesla because everyone trades Tesla, because it has high volume, because it's like the stock everyone talks about. I'm not saying people trade that to fit in. I'm not saying people trade that because it's like the biggest stock that's mentioned on social media or just within stock trading groups. That can also be in correlation with Amazon, with Nvidia, with Microsoft, with SPY and SPX. The purpose of why I use watch lists, and as I go through these pinpoints, I'm going to switch over to my exact Weeble setup that I use for charts and visualization. I don't trade heavily on Weeble, but I use the charting system just because of my style works best for that. So when talking about watch list, the biggest thing that I tend to do is like categorize stocks that I already watch, but I want to see uh irregular movements within numerical data. And what I mean by like irregular movements or statistics that don't align like they should. Let me find a way to get this. There we go. So when I have my watch list, the biggest thing I look for is irregular volume. And when I say irregular volume, I'm not saying like, let's say Tesla has heavy volume. I'm looking for like abnormal. Tesla always has heavy volume. Someone could say, well, usually they have, let's just say for an example, it may not be logical, but just an idea. If Tesla has on a regular day 10 million volume in the first 10 minutes, let's say a weird day they only have 2 million volume in the first 10 minutes. That is the type of irregular numerical volume I look for with specific stocks. So if we're looking at, like for an example, let's say Amazon, and they have a news drop in pre-market, maybe they have news after hours a day before, so their volume in pre-market is way higher than usual. That's going to give me a visual representation of I need to watch this heavier because multiple eyes are on this. There's volume engaged, which is going to carry that stock to have a major move in one direction. So I'm looking for the things that many people may not focus on. Most people, it's like, oh, well, this stock's up 10% pre-market. I'm only going to watch this stock. Well, why is it up 10%? Is it the news release? Was there heavy volume that pushed the price upside with buyers outweighing the sellers? You want to find like that little difference that you don't usually see with the stock you watch every day. Or if you watch a handful of stocks, you pick and choose maybe what's hot on the day based off the ETF sectors. And this was a class that I taught a few months back about knowing which sector is hot on the day, using the top stocks in that sector to use to your advantage. It's kind of like any entrepreneurship job, whether it's a 9 to 5 job, business, or you have your own that you're doing. You want to find what's hot and that you can capitalize on before other people catch on to it. You're finding that little difference that many people don't notice until, for market representation, hours into the market, or maybe just for business in general, you're weeks ahead of other people to get the ball rolling before other people catch on. So I'm looking for things that many people don't tend to look for. Everyone's big on the percent the stock is up. Everyone's big on the volume, but they don't calculate what's normal compared to abnormal. What's different to actually make me catch my eyes on what I'm looking at. So when I'm looking for a regular volume, I don't just look for heavy volume. Like say, like the example, Tesla on average, let's just say 10 million in the first 5 minutes, but now they only have a million the first 5 minutes. I'm not looking at that saying, okay, this is low volume, this is weird. I'm waiting to see if it picks up. Is there a reasoning behind it? Like, what's the cause? Not just, oh, there's low volume, this is weird. And then I just go off that. There's always, it's like a domino effect. One thing leads to another, and that's what causes a specific change in the stock momentum, the stock movement, the volume, the percent up on the day. You want to find that little tweak that many people don't notice until it's too late. They chase the play. Maybe they force a play based off, oh, it's high volume. It's going to go upside because people don't realize volume can be high, but sellers are taking over the volume pressure. So you have to understand what you're looking at and be very familiar with specific stocks that you comprehend from watching them long term. You don't just want to look at a stock one day and then the next day you look at it again and you're thinking, well, this wasn't how it was yesterday. How don't you know that the day before wasn't the abnormal and now today's back to normal? A lot of people just follow the hype, like the example I use with Tesla. And that's one thing that I try and stay away from. I don't like to follow the crowd. I like to catch on to things beforehand. So that way I'm already profitable, or in my favor, I'm up compared to other people joining that could be in a higher risk, lower reward stage compared to me. And then, of course, what I just spoke on a few seconds ago, the percent increase on the day is that a main go-to on the stocks that you're watching. Many people, and I'm pretty sure this is not a biased statement because I've helped enough people, I've talked to enough people to know like what they look for. The biggest thing that people tend to do, they see one stock is up massive and they only want to trade that. And when I say up massive, I'm talking, let's say like Amazon's up 1% off open, AMD's up 0.5%, and then you have Nvidia up 15% off open. People gravitate towards where the crowd is. And for me, I like to find stuff beforehand, whether it's the day before, a week before, trying to find and get in line before other people flood in behind you. That way, when you're ahead of the game, you're not stressing when like that change happens. You're already inside of the actual trade, whether it's the idea of it or the actual like physical you're buying in with the money you have in your account. So you're ahead of these people chasing based off hype, possibly off FOMO. They just want to like have that adrenaline rush, that euphoric feeling of doing it instead of actually knowing why they're doing it. So going off of charts, off of the watch list now is the whole idea with charts. And for me, what I use is the contract chart. So just simply going off charts when people have them on their setups. Many people, they trade the 1 minute, the 2 minute, the 5 minute, sometimes only the 1 minute. Many new traders are not very educated on reasonings behind like what does this time frame do? Why do you use this time frame? Like why is the 4 hour important? Can you explain what happened today? Uh, Send me that message again once we get to the charts. Once I switch over to Weeble, and I can do like a visual representation for like what you're asking about. So like with the charts, many people don't really. I hate saying comprehend because it's not really comprehension. It's just lack of knowledge to learn what they want to do or like what they're using. Chart timeframes can be used in stages or in sediments that many people try and tie all in one, which don't work for specific systems. The way that I use my setup when I'm using chart timeframes, this is all personal biased. I'm going to keep repeating this so you know I'm speaking on what I use. I'm not saying it's right. I'm not saying it's wrong. It just works for me, and that's why I'm speaking on this, because many people can pick and choose what I talk about, see if this works for them. Not everything's going to work for you, what works for me. So that's why I'm briefly touching on multiple topics on my specific setup to see what you guys can pick and choose from it. So when looking at chart timeframes, when I'm looking at the 1 minute, why does it keep doing that? There we go. The 2 minute or the 5 minute. Actually, I'm gonna do the 3 minute. I don't want to put the 5 minute in this one yet. So when using just the 1, 2, and the 3, this is more ideal for scalps. And I'm not saying you buy, you sell 20 seconds in. I'm just saying your mindset is telling you I'm on these time frames because I'm looking for a quick trade. It's not a time frame of I just want to get 30 seconds in. You're playing the chart every time you trade. The whole idea of hope or just the ideal of imagining what could be, it throws off why you're on those time frames. Many people, they buy in, they're up 20% within a minute. They don't want to sell right away. Are they like imagining, okay, I'm going to sell if I'm up this amount of percent? I'm going to sell if I get a quick percent jump in my favor right away. They don't have a conclusion for what they're going to do when the results start to show. So when I'm always playing the 1, 2, or the 3 minute, I'm focused on scalps. I'm focused on this setup on my screen is only for a quick in and out. I'm not buying in and say I sit at, let's say I'm up 5%, I'm back to break even. I'm down 5%, I'm back to break even over like a 10-minute time frame. I'm not going to hold this trade because I'm not profitable on it yet. My initial thought process being on these small time frames, I want an in and out position. I don't want to hold this. I don't want to hope for a big move. I don't want to be in the red and tell myself, well, let me just give it a few more minutes. I have an idea in my head, and that's why I use this specific scalp for the smaller time frames. Candles move quicker, candles form faster. So for me, I take that as this is going to be a quick trade. I'm not changing the way I feel when the stock sits and it doesn't move. I'll sell for break even. I'll sell for a 5% loss because regardless if I win or lose on that trade, I'm expecting to be in and out and not have stress with that. So I'm working over to now the 5-minute, the 15-minute, and I guess I can throw in the 10-minute here as well. So let me do that because many people tend to use both of those in sync. And then, of course, I'm going to go with the 30-minute. So looking at the 5-minute, the 10/15 minute, and the 30-minute, this tends to be, some people scalp on these, which is perfectly fine, but I consider scalps. I'm going to come back up here just to type this. Seconds to a few minute trades or trade. So when I'm looking at the 5-minute, the 10-minute, the 15, the 30, I'm not expecting to be in and out unless the move presents itself that way. Initially, I'm thinking, okay, I'm looking at the bigger frame on my actual setup currently as this is pulled up. I'm not looking to buy in and sell within 30 seconds unless the move just happens that way. Everyone should understand that when you play time frames, you are playing not just like making money, you're playing whether you're on the bigger time frames, it's more of a length. More stuff has to form to get the move you want. When you're playing on these small time frames like the 1, 2, or the 3-minute, you're going to get rapid responses, rapid pushes, rapid drops. That's what you have to expect trading those smaller time frames. With the 5, 10, 15 to 30, you're kind of stuck in the middle with like a swing trade, a scalp. It's more so like a day trade, or you're looking for like that continuation move. You're not expecting to get it quick, but you're also not expecting to hold it for over a day unless the opportunity presents itself. So for me, I'm more so focused on day trades with this. And it isn't like I'm like everyone that talks to me about like how do I trade this style, like why do I use the 30 and the 15-minute? That's my ideal go-to. That's my personal go-to. It's a biased observation. I favor the 15 to 30-minute, not because it works good for me, but because it limits my stress, it limits my emotions, it keeps me in check with who I am and not who I hope to be based off money I can make in a quick time frame for a scalp, or maybe size heavy with the bigger time frame trying to catch that big move. So I love specifically the 15 to 30. And I'm going to emphasize that because someone may take that and try it out next time. Maybe you only trade the 1 or the 2-minute and you're going to try and pull up the 15 to 30, and you're going to realize looking at the charts, like I feel so calm. I feel relaxed. I'm not freaking out when the candle forms. It makes yourself wait, which will result in less trades, better quality setups. Long-term mindset is what that will do for you. I'm not saying that's the only thing you should do, but if you struggle with not even executing, but just being profitable, don't focus on those small time frames as a new trader or just being a trader in general. If you're not seeing success over a few months or a few years now, I recommend trying to trade on the bigger time frames. Not because it's easier, but because you will lose less money and you're going to be waiting longer for a proper setup. That's the whole idea with what I look at with not even just trading, but just like finances in general. Nothing happens quick that stays forever. And if it is, you just get lucky back to back to back. Trading is one of those things where you can't just throw money in, you win. You throw more money in, you keep winning. Eventually, when you oversize or you overcomplicate like your ego, you think you got this down, you get humbled quicker than you ever made money before. As in, you lose money faster than you've ever made 2 months in time, maybe even a year in time. It's easier to lose than it is to win in the market. So going off of now the bigger time frames, which I'm sure many of you possibly use, and if not, this is also another thing that is good to look into, possibly even check with your own self. I'm going to put most all of them for this one. So when we're looking at the 1 hour, the 2 hour, the 4 hour, the daily, the weekly, you can even say the monthly, the yearly, whatever you want to look at. These are the time frames that literally put you in a position to wait. And I'm not saying like wait a day to trade. This could be weeks you're waiting for a setup. It could be 3 to 4 days you're waiting for a setup. Everyone should understand when I keep going back to the 1 minute, the 2 minute, and the 3 minute, you see setups all day, every day. Maybe every 5 minutes you see a new setup. Maybe every minute you see a setup, because candles change our emotions. When you're on these bigger time frames, you're not focused on the money. You're waiting for the setup. You're waiting for the opportunity. The growth is what I like to call it. It's not like you're rushing into a play. You're sitting back waiting for the play. And it changes the way not even you trade, but the way you feel about what you want out of trading, because it teaches you like this is not going to come easy. It's also not going to come quick. So you have to be patient with it and realize larger pictures take longer to paint. When you have the 1 minute and the 2 minute, these candles are forming every minute, every 30 seconds. They're moving quick. You don't see the bigger picture. You're looking at the smaller frames, aka the smaller picture, and you're trying to paint it before it even happens in front of you. You're imagining things. You see a huge red candle. Now you're thinking, well, a huge green could come right after this to push it back up. When you're looking at these bigger pictures, if you see a major red candle in the 2 hour time frame, you're not going to see another 2 hour candle just fill that entire gap back up to where that red candle started. It's not going to happen that quick. So you have time to process. You have time to think. And this is when swing trades come into play. So when I talk about these three main right here, I'm not talking about these from a trading perspective. This is how you can utilize a system of what you look at with charts. If you don't have the patience, if you're not like you can't sit and wait for things, you may have to be content trading the 1, 2, and the 3 minute for those scalps. If you want to learn to grow patience, you're going to have to be uncomfortable, which obviously everyone should understand. Being uncomfortable is where growth comes in. You learn more about yourself when you're uncomfortable, putting yourself in situations you have to grow from, to learn from, that destroy you to build you back up. That is when these timeframes come into play. The 5, the 15, the 30, and the 1 hour all the way up to the 1 week. When you look at the bigger picture, you put yourself in a position to look and watch. You're not looking to attack. You're waiting. You're waiting for the proper alignment. A lot of people can't do that because they have to do something today. They have to see a result. They have to see an action done. You can't force anything in the market. So when using these time frames, just like what I said before I started this class, it's all personal bias why I speak on the bigger picture. I like it because I lose less money long term. And I've also been making way more money ever than I have before using the bigger picture on the time frames. I'm not saying do it. I'm also not saying avoid it. Just think about it. The whole idea of you being here to listen to this is to get a new perspective, to try new things. No one got stupid trying new things. They just realized this isn't for me. I'm not going to try it again. That's one less thing to worry about. So you have to understand it's not the fact that you're cutting out what you're doing now. Just think about, have I been profitable? Have I actually made headway forward with trading, doing what I've been doing for the past X amount of months or X amount of years? There's nothing wrong with trying something new with a readjustment. I'm not saying change the entire system you're using, but just think about maybe having, if you always trade the smaller time frames, put a side chart of like the 1 hour or the 2 hour of the same stock you're looking at, just to see how much smoother these move on the bigger picture compared to what you're looking at on the smaller time frame. You may see entries on the bigger time frame that will make you wait to get in on the smaller. You never know how it could work for you personally. And this is one of those things that I teach, and people tend to be very confused because not many traders that I have talked to, that I've been mentored from, that I've mentored personally, not many people have heard about this kind of concept before. So the contract chart. I I don't want to say I'm one of the only ones that I know of, but I don't know many traders that use the contract chart to find positions. And what I mean by that, so when looking at the contract chart, I'm going to put this on a whole nother page. The contract chart is not there to tell you when to sell or when to buy. From my perspective, when I use the contract chart, I'm focused on, and I'm going to type this before I say it just so I don't misspell any words. So when I'm looking at the contract chart, I'm focused on the best entry. I'm not looking at it like, oh, well, the contract is 1.5 right now. Yesterday when it was up higher, it was 3.5. I could make money if I just bought in right now. I'm using the contract chart to find the best entry for the contract I'm watching. It's not just the how much can I make? How much could this contract really move? I'm using the contract chart and I'm using that with the actual stock chart. If you know on the stock chart where you want to buy in based off, let's say, support, maybe a resistance level, maybe a specific pattern, or maybe even just something very basic of it's at this exact price per share. I want to buy into a contract when Apple hits 190 a share. You can literally use the contract chart for the specific premium that you want and mirror that to the stock chart. So let's just say, for an example, and I'll switch over to Weeble in a little bit to like show you guys an example on this, obviously. Let's say Apple is currently trading, let's just say 191 a share. So you're looking at Apple and you're telling yourself, I only want to buy into Apple. Let's say play Apple at 190 a share. So just going off this simple analogy, you're not even focused on entering right now. You want to see Apple pull back. And for the people that understand this, you're waiting for a support zone that you possibly see at 190 a share. This is not a realistic example. I'm just giving a informal example so you guys can comprehend how I do this. So if you're only waiting for Apple when it touches support or whatever it may be at 190 a share, you can literally look at the Apple chart, the stock chart. We're stuck on words and symbols. Look at the Apple stock chart and use those levels to find proper entries on the contract premium you are watching. So literally when I do this, it's not hard to do when you understand the concept. Many people, when I talk about this, they're stuck on, well, how do you know how much it will cost? It's not the idea of knowing the exact pinpoint, which I've gotten very good at over the years, but it's just an idea of where could this contract be priced at so I can plan ahead. I can prepare for this trade. This is one of the biggest ways I don't have emotions when I do enter positions, because when I know, let's say, and I'm going to come back up here and do a little this thing. So you're looking at, let's say, the one, once again, it's not a logical example. I'm just giving numbers so it works out good. So you're looking at the 195 call. And when Apple is at 191 a share, price is at, let's say, 1.00. So for Apple, when the Apple stock is at 191 a share, the 195 call, and let me actually do this just so it looks better for you guys. The 195 call is at $1, aka $100 a piece. You only want to enter this contract, the 195 call, when Apple stock hits 190 a share, aka it drops $1 share price. When looking at the contract chart, you notice, okay, last time Apple was at 190 a share, the contract, I'm going to type this up real quick. All these addresses, I don't know. There we go. So when Apple was at 190 a share, that same contract was 0.45. So currently, Apple's at 191 a share. that contract you want is $100 a piece. For me, when I look at stuff like this, I'm focused on, okay, my support level, quote unquote, my support level for Apple is at 190 a share. Why would I want to buy or rush into this play at $100 a piece when my support I'm looking at, the contract was literally just $45 a piece? So just looking at that, that's over an 100% difference. That makes me wait even longer for this support to hit, or for at least this share price on Apple to touch. Because when I find that, I have a proper entry idea. I may not get the same price. I may get it less. I may get it slightly more expensive. It all depends on the delta, the intrinsic value, theta decay, all of those Greeks and the numerical symbolization comes into play. So I'm not dedicated to 0.45. It's a rough idea. This is when the idea of calculating your risk to reward or just your position size comes into play. Let's say, I don't want that underlined. Oh, well. You only want to put in $300. So using the current of Apple, you can only buy 3 contracts, because if you buy right away, those 195 calls are $100 a piece. You can only buy 3 contracts for what you want to put in for that position. If you know ahead of time, well, I have a support zone at Apple at 190 a share, that same contract, if we pull back to that level, last time it was at that same level, the contract was $45. So would I want to rush in now, get 3 contracts for a total of $300, or do I just want to wait and possibly get 6+ contracts and save money I put into that position? So I'm like preparing. I'm not saying I'm going to get in at $45 a piece. I just have a good realization of what could be. So it's holding me back from forcing an entry if I see a massive green candle and this price goes from 1.0 to 1.4. I don't want to chase because I'm focused now on this amazing price I could get, which correlates to that support zone at 190 a share. So it gives me like a calmness. It helps me wait. It lets the chart form. I'm not rushing into the play based off, oh my gosh, we broke out of a massive resistance. I have to get calls before it keeps sending. I don't care about that. So I'm only focused on the proper entries when I use the contract chart. That's the only reason why I use it. It's very good for me. It's been a huge benefit. And that's one thing I will show you guys once we do switch over to the Weeble chart in a few minutes. So the last thing that a lot of people have asked me about, and I will briefly speak on this as well, but I don't want to give too much out with what I personally use because I don't really emphasize that to people very often. But the whole idea of indicators, or like what do you use for like your quote unquote secret sauce? Many people use time and sales, aka the tape, the order flow. Many people have specific indicators they use, whether it's the EMAs, whether it's the VWAP, the MACD, maybe it's even just volume shells or the idea of volume increase on candlesticks. So when going over these, this is all obviously a biased opinion of me personally. I tend to use tape, but I only use that mostly for the contracts. I don't watch tape as heavily on shares for the actual stock. That's only because I've back tested things that fit my style of trading. I'm not saying, oh, tape for shares doesn't work. Every trader has their own specialty that works for them to make them 6 to 7 figures or just be consistent in trading. For me personally, I tend to stick with the EMAs, which I'm going to bold the ones I use the most just so you guys can visually see. I use VWAP rarely, but I do use it. Volume shelf, I peep. And by peep, I mean like I look at it occasionally. I don't always have it pulled up, but these are the main 3 I'll speak on. The MACD, there's a lot of misguidance about how to use it with the divergence, knowing the bullish to bearish, knowing the intertwine of the stock coming down, but the MACD is moving upside. Finding how to use divergence is very useful, but the larger time frames is the most effective from what I've back tested for me personally. Everyone does things differently. Everyone has their own personal idea of what they think is best. So I'm only going to speak on what I actually use and what works for me with results in the end of my trades. So when looking at the EMAs, the main EMAs that I use, and I'll give you guys, I'm not going to go into deep detail about how to use them, but I'll give you like what I do and on like specific time frames when I use these. For my setup with the EMAs, when I am scalping, I will use, and they're all the same, obviously. I use the EMA 9, EMA 21, and the EMA 55. And when I do use these, I am on the 2-minute and the 5-minute time frame. So a lot of people, it's like, well, why do you use those time frames specifically? It's all back tested. It's not because they were cool, they looked good. I back test everything for months, if not years, half the time, to make sure that the probability long term is going to still be beneficial to me, even when the market has its differentials with like bullish to bearish, whether it's chop or consolidation. I find systems that are always effective no matter what the market throws at me. Kind of like when anyone's in any entrepreneurship or any business or company, you find an edge that works good for you, not more so that just works in the moment. A lot of people tend to do that, but with trading, it's very good to be secure and confident long term with setups that you use, or just the idea of what's best for me. I'm not very big on personally using things that only work for like a few days or a few months. And then when the market changes, you have to throw that system out the window. I have multiple ones that I go through, whether it's scalping, day trading, or swinging. And the EMAs is what I tend to use the most for all of those. So when I day trade with the EMAs, same thing as the above. I use the 9, the 21, the 55. Not much changes for me when I use the EMAs. All the biggest change is the time frames. That's what makes it work the way it does. So I use the 15-minute and 30-minute time frame. So when I use the same EMAs, the 9, 21, 55, there's many people that use like the 8, the 20, and the 50, the 9, the 20, and the 50. Everyone has a different number. A few number difference doesn't make that big of an effective visual when you're looking at the contracts move or even just the stock candlesticks. The biggest thing for me, I have tried like the 55, I've tried the 50, I've tried the 60. For some reason, with the style that I look for and like the candlesticks that reject and bounce off of my specific EMAs, the 55 has been the biggest correlation for what I look for in a system when it comes to day trading. Scalping is not as heavy with the 55. I'm more so focused on the 9, the 21. And as I finish up the swing trades, I'll come back up and I'll type in like what exactly I look for to make these systems play out for me to enter and also to sell when they do happen into effect. So for swings now, once again, I use the same EMAs, but there's one difference that I do have on here. So I use the EMA 113, the 200. So when I use the 113, which I'm sure a lot of you may remember this, I use the 113 mostly with Amazon. And for those of you that just like gave them like a back thought, like, wait, why does that sound so familiar? I learned that from a mentor that used to trade Amazon before the split. And for you that know Mir, yeah, so someone just said it. There we go. So after the split, I didn't see Amazon move the same with the 113 and also with the system I was already back testing at the time, the 9, 21, the 55. With swing trades, this is more picky when you're looking for a system with what I use personally, with the 9, 21, 55, and then the 113, the 200. Not every stock works for swing trades, but for some reason, the day trades and the scalping tend to work good only because it's small movements that make them hit the way they need to. The bigger picture, which when you correlate the swings with the days and the scalps, this all goes back to this stuff up here. Scalps is the 1 minute, the 2 minute, and the 3. Day trades are the 5, 15, 30. Swing trades are the 1 hour plus. That same idea goes with the EMAs that I use for my specific style, or like my screens I use with indicators. I'm going to hurry up and type this real quick. Okay, so before I come back up and speak on the EMAs, I am going to finish the VWAP and the volume shelf real quick because this is probably going to take a little bit to explain. And like I was saying earlier, I do want to have a visual with the contract chart and also the EMA idea with the actual Weeble charts pulled up. So I will pull that up for a visual once I go through these last few. So with the VWAP, and I'm sure almost everyone has heard about the VWAP. I mean, it's one of the biggest retail indicators that people promote on social media. It's one of the biggest ones that work with every stock since it's literally like the basic. It's the go-to for almost everything. So with the VWAP, I only use this for intraday trading. When I say intraday trading, many people that only trade open, they think intraday is like 11 a.m. Eastern, noon, 1 o'clock. My intraday trading is usually 2 to 4, aka the last 2 hours of market open. The reasoning behind why I consider that intraday is because I don't trade open. I tend to make my day start with trading around 10:30 to 11 a.m. And that gives me the intraday feeling of going into power hour or just using the hours after lunch around 1 p.m., 2 p.m. to start using the VWAP for the rejections or the bounces. The VWAP plays into effect on the smaller time frames. Obviously, you can use it on like the 30 and the 1 hour, but you need smaller movements for this to work best. The 1 minute, the 2 minute, the 5 minute, possibly the 15. But when you have candles that are very widespread, because obviously the bigger time frames you use, the candles are going to have more of a gap to fill. Like Apple with the 1 hour can go from 189 to 191 in one of the 1 hour candles. But if you're on like the 5 minute, Apple may not move a $2 a share push in that 1 5 minute candle. So that's when the VWAP is most effective, is on smaller time frames. So going with the volume shelf, this is very simple. This is not going to take a lot to really explain because I don't use it as much as most people do. But the overall perception and the overall idea of a volume shelf is to see where the volume hits the most based off shares price. So when you're looking at the volume shelf, and I'm going to pull up a picture to draw, see if I can figure this out like last time. There we go. And then free draw, where are you at? Scribble. So when you're looking at a chart, I'm just going to draw random up, down stuff. You have the chart. When you have this going, the volume shelf gives you a visual representation and overall idea of where the volume is heaviest within these moves on the candle. Obviously, it's a line chart if you want to call it technical terms, but imagine this is like the candlesticks moving up and down. So the volume shelf is always going to be on one side of the chart, and it shows you levels. And by levels, it's the volume heaviest to lowest. So I'm just going to, this is going to be very bad, but I just want to get an example going for you guys so you understand like how this works. So when using the volume shelf, I'm going to, there we go. So the way it works, when you see the volume shelf, it's like the same as seeing the candlesticks on the bottom. When you see these wicks, like when you have like the overlapping volume or just volume on the bottom with the candles that correlate with the actual candlesticks for the share price, you see them going like this. Imagine that the same way with the volume shelf, but showing you where price is heaviest based off support, resistance, or just the zones within the formation of the stock chart. So when using these areas, this will show you like mild volume. This is the massive volume right here. So when the stock came to these areas, and I'm going to put an arrow in here. I don't know if I can make that bigger or not. When the volume came into these areas, this is where the volume is heaviest, where people buy in or they sell the heaviest. So on pullbacks, when these volume shelves are bigger, like the overlapping volume on the bottom, or the like if they're taller, there's more volume in that candle time frame. Same way for the volume shelf. These areas give you where people load the most or unload the most based off the volume coming in and out. So you see in this area, volume gets picked up here. Volume gets picked up here. Up here is where people usually sell it off because as it pushes, that's where the volume comes in and it shows you on the volume shelf. This is a very bad representation, but this is a good idea as to how. It's the same thing as the overlapping volume on the bottom per candlestick on the time frame. It's just on the side that shows you with the consolidation, with support and resistance, where the volume is hiding on the chart setups. It's not always 100% accurate, but it gives people a good idea how to use that for their trading. And I want to know if I can just cut. How did I cut this last time? I think it was like this. Yeah. So when using this idea, people tend to have like a stock going like this. And when they use the volume shelf, it's very heavy down here. A lot of volume being picked up. And up here, it's very light. There's not as much volume based off the shelf. So people tend to use this as, well, not many people are buying up here. It's light. So maybe we're going to be tapping out at this quote unquote resistance based off the chart. Volume shelf is light, showing that on the volume pressure. But every time we come down to the bottom, people load up. So it's like a bounce zone down at the bottom here, aka the support zone based off where that is on the chart. This is a rough idea as to how volume shelves are used or portrayed by people. I recommend looking up more videos of this because I am not very well in tune with it. I don't use it as much as most people do, but that's the idea of it from a visual representation. So I'm going to switch over to Weeble now, and I'm pretty sure you guys can see this. Yes, you can. So I'm going to show you the idea of contract chart to stock correlation, just to show you like what I use for my screen. This is my main go-to that I personally use, and I will speak on it once I get this stuff pulled up. So I have the stock chart to the left. This is Netflix chart from today only. I'm on the 5-minute time frame. And then I'm going to pull up an idea level from a contract premium I'd be looking at. So off open, I'm going to put levels down so you guys can see the price of the shares. Netflix opened roughly around $438 a share. Around that area is where it opened up. And as you can tell, the first 5-minute candle ripped. After that, it just zoned and went to high of the day and then kind of didn't go much higher than that. So hypothetically, you're looking at this stock off open. You see it push right away, and you want to get in on this. So if you see this push happen, obviously from the open around 438, it goes right up, and I have a level here at 444.5 area. So when looking at this specific area of this bounce, it breaks above, and I'm going to switch to the 1 minute just so I can show you this better before switching back to the 5-minute. When we break above the 444 level and we pull back to it in this area right here, what I tend to do, so let's say around here is 444, it pushes up to 448, and you're waiting for a pullback because this level I've had this for months. So if I'm using that as like, this is my support, Netflix was at 448 at the high off open, I want to catch a pullback to 444. So looking at this, okay, I'm looking at the 450 call for week of. So I go into Netflix, I go to the 450 call, pull up that contract chart. What I do next is I find where the pullback will hit. So if we're looking at Netflix on the stock chart, we have these 3 candles at that level, which Eastern time, 9:34, 9:35, 9:36. So I find that on the contract chart, 9:34, 9:35, 9:36. So I'm going to highlight this just so you can see the correlation between the two. And I'm going to put a price level so you see how much it cost around that area. So the contract was roughly $400 on the initial push upside. And as it kept going higher, the contract went to 5.58 at the high. So if I'm looking at Netflix, I don't know that it pulls back. I'm just preparing. So I'm taking you like through the actual like open of Netflix from this morning. As we broke my level of 444, I want to see a pullback after this high hit. So as this chart is forming, I see the contract doing this. When it broke the level that I was initially looking at, which is the 444, the contract was roughly $400 a piece. And it ran up to 5.58, $558. If I'm waiting for that pullback, I know for a fact, this isn't like a guess, it's a fact. If we at least come and contest that same level, I am 100% guaranteed to get it cheaper than the first time it touched the level on the upside. The intrinsic value raised the price. As time decays, the contract will lose value. So when it pulls back, I am guaranteed to get it cheaper than $400 a piece. It's a fact. It's not a guess. It's not an estimate. It's 100% guaranteed. So I know right away, okay, well, if I want to play the 450 call on the recontest of the 444 level, I'm going to pay less than $400. And if we do somehow recontest the high that just happened, I am guaranteed not the high price, but at least 500 because time decay will lower the value for the contract. So as this pulls back, the contract's going to pull back. So I'm already knowing I can get it cheaper than 400. So why would I pay 500? Why would I enter in this area? I'm going to change this highlight to orange. Why would I even enter if I just told myself I'm only buying if we can test that level at 444, which is this red highlight? I'm only buying if it comes back. So seeing this, I know I'm not paying over $400. I will not enter if it's over $400. So as this pulls back, the contract pulls back, obviously. And that's when, as this approaches, I can see the contract chart moving the way I want it to happen. How do you know it will hold, though? So that's the biggest thing about trading. Nothing's guaranteed, but if you know how to chart levels, that's when support comes into play, support bounces, resistance, all that kind of stuff. If we go on the 30-minute for Netflix, look at the 444 level from the day before. This was like the high from that past Friday. The 444 level historically, I'm going to change this to yellow and I'm going to make it thicker in a dotted line. I'm going to go the 2-hour time frame so you can see why I put that level there. We've had rejections before around that zone. It's not a pinpoint of 444.47. It's just the area. You can literally move this down to 44 even, 444 even, 445. It's just in the zone where I have that level because it respects price action. Every time we've approached this level historically, we don't hold above it. We reject it pretty close to that zone. Everywhere around that area of $444 a share has correlation with price action. So that is where I come to terms with using and trusting levels that I chart. So when this pullback happens, it's not just like, oh, 444, I want to see it bounce. Last Friday, we cannot break and hold above that level. Yes, you can say, well, why not 445.5? That is not where I had this level before this day happened. So when this day happened, we rejected right at where I already had this chart. It's not a guess. It wasn't like in the moment when this tap out happened, I put a level here and said, okay, this is now a level. I've had this level for months on Netflix. You have to trust levels, even though it's very difficult to, because human nature, we want to see things happen before we trust it. It's very hard to just do things. It's like a dream you have in life. You have this dream, you don't know how to do it though. You just have to trust yourself. You have to trust the process that you're going to make it happen. It's going to become realistic. Same thing with charting. You have to trust levels because you're going off historical movement. These levels don't just happen. Price action does not just happen. All of this is priced in. It all happens for a reason. So if I go back farther with this 444 level, we can see correlation where these daily wicks have actually literally respected that zone almost dead on. So I trust historical price action to make me respect that level when it comes back up in the future. That is why I knew, like, this is my low risk. If you focus on like how a lot of traders are, and I'm on the 1 minute time frame right now, so many traders see like it's pushing, pushing, pushing. I gotta buy in. Well, like, where's your price target if it keeps going upside? Where is your cut level if it comes back down to the downside? Not many people focus on that. So I only trade levels. I trust them, even if they don't work. Entry here is a low risk compared to buying up here. Because if you buy calls at the high here, you're paying 500 a piece. It pulls back to a low of 3.65. Then it pushes back up and now you're profitable. So I let the levels give me my entries. I trust what I can't see right now, but going off historical relevance with price action, this level has respected price action before. So I have to trust it. I have to put my charting to the test and let that guide me. So when this pullback happened, obviously the contract went under 400. So that's when it's personal biased as to when do I want to enter. Do you want to only put a limit at $400 a piece for a contract? Do you only want to like wait to see how it reacts down here? As this consolidates, you can enter at any point from 3 because this wick, you may not get it dead on. 3.65, it's not a logical entry point to guess or to know ahead of time. But you know around or under $400 you're going to get as long as this level does hold. So you buy on that red candle. So I buy when I feel confident with it's holding support. Many people, they buy like, boom, it touched, I'm entering right here. Some people want to see it consolidate and then they enter once they see a visual. I'm very big on just trusting levels as they hold. If I'm on the 5 minute, which I use the most, I told you guys I'll switch back to this once I explain on the 1 minute. So on the 5 minute candle, this is what you'd see. This is why I like the bigger time frames. When you see the 1 minute, you had like candle, 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 and then it started to take off. On the 5 minute, you see a red candle, you see a green candle sporadically going up and down for 5 minutes. This is when I enter in between the red and the green on the 5 minute. Because in that moment, if I switch the contract chart to the 5 minute, we will get an entry point roughly around this area of a $365 up to $400 in this candle wick. So I know ahead of time I'm not buying for $500 because the level I want to see recontest at 444, that is my entry. So I wait for the pullback, I enter, and then if this level holds, notice how I said if, it's not a guarantee, it's all low risk, high reward. That's all trading is. There's no secret sauce. You're going to lose, you're going to win. Limit your losses, maximize your reward. If I enter at this red highlight and this level holds and keeps pushing, this is when I only sell based off the chart, or I start using my EMA for a scalp or a day trade. When I use the EMAs, and I'll pull this up right now. So I use the 5 minute when I use the EMAs for a scalp. I don't tend to use the 1 or the 2 or the 3. I use the 5 minimum for the EMAs. So as Netflix holds this level on the pullback, I'm going to hold this position while the 9 EMA stays underneath the candles, which means I'm not selling based off what I do for my strategy until this candle broke underneath, which was 11:30 Eastern, which makes the contract cost roughly $700 a piece. Entry at 400, exit at 700. You just made $300 a contract based off a level hold, and then you trust the EMAs to guide you and hold trends above that 9. Do you also use time and sales to enter? So my time and sales is literally the contract volume. I look at the contract time and sales. I don't look at Netflix time and sales. I don't look at tape for the stock. I look at tape for the contract. That is what I personally do. When I use the contract tape, and I don't know if I'll be able to scroll back all the way to that specific time that happened, but let me see if I can go far enough back. And this was what, like 9:36 I said earlier, I think it was. Let me just keep scrolling. So when I use the contract tape, I can see where people are filling below the ask. I can see where people are trying to buy above the ask. I see where the price is being chased or it's being sold for a scared price. Like I got to get out before it's too late. When the bid's at, let's say $3 and I see an order fill at 270, I know someone's trying to get out below the bid, which means they're scared. They're trying to they're rushing. They're scared. They're emotional. I see that on the contract tape and I use that to my advantage. So when these pullback happened, and that was 10:05. Was that when it was? Yeah, 10:05 was the pullback. So when this pullback happened on the tape, so as this 10 o'clock volume comes in for the contract right here, I see all these orders. Red means filled at the bid. People are selling scared, which means when contracts are sold below the bid, the value drops. The value is cheaper than what it actually deserves to be respected as. Same way as when the contract flies on the upside for calls, people chase the ask. The price is higher than what it deserves to be. I see that on the contract tape. I see the contract's overextended. I'm not going to buy calls right now because people are chasing, pushing the ask. The minute this sits and consolidates, just because the stock is not dropping, the contract will lose value because as it sits, people sell. Same way with the downside. When people are in calls at the push and it starts to pull back, they sell below the bid and they drop the price massive, even though it doesn't deserve to be dropped that low. And that's when I use the contract chart for correlation. This 3.65 sell someone had it 10:01. Let's look at this as a group real quick. See if I can find it. There it is. So right here, 3.65. There was no heavy volume. There was one contract here, one contract, 3 total contracts bought and or sold at 3.65. It's a scare tactic. So I know no one's loading heavy. No one's selling heavy. It's just people are getting out below the bid. Price pushes right back up to 3.85, the $4. Now it's holding respectfully. Going off the Netflix chart, price is holding at that level I have, which means the contract is back to where it should be priced at logically. It's not overextended, it's not oversold, and now it's back to normal. So as this sits, I'm entering, and then I trust the EMAs to carry me. I'm not selling because I'm up $100 a contract. I'm holding because the EMA 9 is holding on the 5-minute. That is how I deal with a hold or a scalp based off momentum. When using this system, it's not going to work every time, but this is how I trust the chart. I'm not looking at P&L. Oh, I entered at 3.9. Contract just went to 4.9. I have to get out. If I would get out right here I'm going to go back to the 1 minute for you guys to see this. This pullback right here that I just highlighted, this made the contract drop from a high of 4.88 to a low of 4.2. A lot of people on the 1 minute, they see 4 back-to-back red candles. They're going to sell because they're scared. They entered at 4, the contract's at 4.9 area, and it just dropped $70 a piece or $60 a piece. They're going to sell scared. The 1 minute is deceiving. Trends are still holding. Higher lows, higher lows. So with my setup that I use, I stay on the 5 minute because the trends are holding better. All green candles. There's not one red within this because it held value. I hold based off the 9 EMA. That's my system that I personally use. So with my quick overview of like what I use to trade, the chart, this is the system. I have my watch list. I have multiple different tabs of like the day of or like my main go-tos for the day. Like if I'm looking at stocks for tonight to trade tomorrow, I put those top watches on the day of. So these are the only ones I watch the day, like tomorrow, if I chart tonight. And then contracts, these are like the main ones I'm watching for specific contracts within the stock shares. I have the sectors I always look at, so I know the overall market view. I keep all this stuff on my watch list. So I always have stuff to cycle through. My main are these ones right here. I only look at these throughout the day. If there's no play on any of these, I don't go over to all my stocks and I go, okay, what's hot on the day? I don't care about any of the hot stocks. I only look at what I'm prepared for, which is the day of stocks that I'm going to be watching. Outside of the watch list tab, I have one main charting stock share. So I just click on it, readjust. So QQ, SPY, SPX, whatever I want to see, it's one click away to go onto my chart. So I'm always prepared for that. So if I'm looking at Netflix, I have the Netflix chart pulled up. Now I'm looking at, okay, so I'm looking at Netflix. I have my contract chart over here. I click Netflix, go to the options tab, find the contract I want. Here's a contract chart pulled up already. With the contract chart, I have the time and sales and the NBBO, which is like the best offer to see where people are trying to fill and or sell for that specific contract if it does approve or go in that way. And this did not switch. There we go. So now I see what the bid and the ask are on this specific contract. If I'm looking at Netflix 450 call and I see the bids at 500, the ask is at 515, why would I try and enter at 515? I want to get the best fill possible from these two, so I'm going to try and fill at 5.0. But when I look at the actual contract chart, so where we are right now, where Netflix closed at, we're slightly below the double bottom intraday right here. So when using that level, the intraday double bottom for the contract was roughly, I'm going to put a level here so you see it, roughly $530 a piece. But it closed at almost $500 a piece, which also correlates back to 1044 area, which is right here. So notice how the contract's holding value. It's almost the same exact on the same share price. So I can see the contract is respecting price action. It's not going lower. It's not going higher. It's neutral right now. So I'm using multiple indications to use my specific system, which is the contract chart. That's what I specifically watch. Does anyone have any quick questions or stuff they want me to elaborate on with a different viewpoint? Anything specifically? It's very difficult to speak on a lot of this stuff in just a short time frame without getting like deep into it with information and whatnot. I'm going to give it a few seconds if anyone's typing. Did you have to go? I'm going to be going pretty soon, yeah. I'll probably, let me see if there's any more questions before I pause the recording. I don't think